Welcome back to our intermediate financial accounting class. In this discussion, we've been talking about all the different parts of the conceptual framework, where GAAP comes from, why we have it, how it fits into financial accounting and into accounting as a whole, and then we started talking a little bit about the expectations gap and IFRS and convergence. Now we're going to transition into a new topic. This time we're going to talk specifically about the conceptual framework and all the underlying theories that lie behind GAAP as it stands today. So with that in mind, let's go ahead and jump into a discussion of why we should care about the conceptual framework. For accountants, you need to know it because you're going to need to be able to do it. You need to understand the concepts and the theories behind accounting so that when you're in doubt, you know what the basics are that you can rely on and say, yeah, I don't really know the specific rules, but here's what FASB I know would have intended. You also have to be able to explain it to others. Look, I know the rule is hard to understand, but I know this was FASB's intent, so let me explain it that way to you. Okay? You also need to be able to search for it and find it, and that would be the third reason that as an accountant you'd really want to know the conceptual framework. If I know the framework, I know where to look to find specific rules. Now, as a non-accountant, you also want to understand why there are constraints on what you can report and can't report, and you need to not push your accountant to go beyond what the rules are and the intent of those rules. With that said, let's go ahead and talk then about the framework. And really the idea was we want to help with the standard setting process. In order to speed things up, FASB decided that they were going to set a framework. CAP had kind of wanted one, the APB really wanted one but never could get to it. Now it was FASB's turn. And they did it, and they had four main reasons or goals that they hoped the framework would provide for them. Let me go ahead and draw a picture again. This time I'm going to draw it as a bridge. So over here are our issues or problems that we're trying to solve. Over here are our solutions. Okay, and we're trying to set or create rules. We'll provide those, and these rules come in the form of GAAP. And what we're really trying to accomplish with all of this is we're trying to create a foundation. So here's our conceptual framework. Our framework for GAAP. And we hoped it would provide four things. So the first of those goals was coherence. We wanted a set of coherent rules that would all flow together and would make sense to everybody and would click both with users and preparers and auditors as well so that everybody's on the same page. The next thing they were hoping to do, the next pillar here of the conceptual framework, was speed. We were hoping, or FASB was hoping, that if we had a conceptual framework it would speed up the process and we could get the rules created faster. Now really, it still takes a long time to set GAAP, but at least it sped up the basic process and getting the ideas out there, even though it takes a long time for all the discussions. Okay? The next pillar, I'll give myself a little bit more room, this pillar is big, is we want to make it more understandable. Understandability. Sorry, it's hard to hyphenate. I thought I left myself room. Anyway, we want to make it easier to understand the concepts and the rules and what's going on in a set of financial statements by having everything be consistent based on that framework. Okay? The last pillar is comparability. I think I just spelled that wrong. Comparability. Well, it's one of the two. Spelling's not my thing. I need a red squiggly line. That's what I really need. Anyway, that was the last support that we were hoping the conceptual framework would provide to GAAP, is by making it more comparable. So this company's books will look like that company's books. From year to year, everything will be comparable so that our investors can see really what we're looking at over time. That brings us then to our conceptual framework. Basically what we're looking at, and you see this pictured different ways, but it's really just a structure, a pyramid, if you will, of different concepts and ideas that we need to understand. Now what we're going to do is we're going to walk through each of these one by one, talk about each brick that makes up this pyramid and how it all fits together to give us a coherent conceptual framework. Okay? So let's start down here with the objectives. And the good news is we've already done these. And if you remember, we drew out pictures of these. It was a key concept that we talked about earlier. So if you remember, the very first one is to take information that we don't understand and turn it into, go from a confused investor who doesn't know what to do, and instead provide useful information that our decision maker can use so he or she knows the decision that ought to be made. So that's our first and primary objective, is we want it to be useful. We want everything to be useful. The second one, if you remember, was the amount, the timing, and the risk of our cash flows. That was our second objective. And the third was to understand the assets of a business. Here's our inventory. And of course cash. And who has claim on those assets? Is it our owners or our debt holders? These three ideas form the foundation for everything that we do in the conceptual framework. We want to make sure that everything comes back to that. Okay. The next thing then that we want to talk about are our qualitative characteristics. And again, we come back to that usefulness idea. We want to make sure it's useful. And in order to make sure it's useful, we want three things. We want it to be understandable, relevant, reliable, and then comparable versus consistent. Let's start with understandable. What we want is, we don't just want a bunch of information that nobody can understand, right? Just random figures and random numbers. That's not what we want. What we want instead is to provide something that all of our business leaders or all of our investors can understand. Now again, like we talked about before, we're not talking about any Joe off the street who's never studied accounting, doesn't know anything about business. We're talking about a rational business decision maker. Somebody who knows a little bit about GAAP, can understand a little bit about the conceptual framework, knows a little bit about journal entries, etc., or about the financial statements. We're writing to them, to an informed group. Okay, not my poor dear grandma, who, bless her heart, loved me to pieces, loved the fact that I was an accountant, no clue what I was doing. Okay, so that's not who we're writing to. That's not what we're shooting for with usefulness. So it's understandable to somebody who knows what they're doing. Let me label this. This is going to be understandable. Next then comes the idea of being useful. And under the idea of useful, we have two key ideas. The first is relevance. In order for something to be useful, we want to avoid having it be old information. It comes out so late that basically an investor looks at it and just says, oh, I'm not interested in that. Right? He's trying to ward it off. He's not interested. Okay? So we want it to be new enough that it's actually useful for an investor. Okay? The trade-off then is we want it to be reliable. Okay. And I tried really hard to think of a good picture for reliable. The best I could think of was Old Faithful. So here's my Old Faithful geyser, right? Reliable. Every 30 minutes it goes off. On the one hand, we want it to be relevant. We want it to come out and be useful and be information that our investors can use right away. On the flip side, we want it to be reliable in that we've checked it and we know it's right, and you can count on this information. And the problem is, it really becomes a trade-off between relevance and reliability. Okay? The quicker we get it out there, the less checking we can do, the less reliable it is. The more time we take to check and verify and be sure, the older the information is and the less useful it is, because it's so old. Nobody cares anymore. So this really is kind of a teeter-totter idea where somehow we got to provide information to our investors that meets both of these. And it's a trade-off, right? And what we've kind of come up with is, about 3 months. So it takes us about 3 months, especially for big corporations, to have them finish their books, have us audit the books and check them, and then provide a set of financial statements. And that's kind of the trade-off we've come up with. All right, the other idea is comparability versus consistence. So comparable means that I can look at different companies and be comparing the same thing. So I'm comparing apples to apples and not apples to boxes of chocolate. We want it to be comparable. If I look at your books and my books, we're all following the exact same rules. The other thing we want to make sure is that we're consistent, meaning that we want it to be circles every year, not circles and then boxes and then triangles. Okay, so we don't want this, we do want that one. Okay, so that's what we're looking for. Okay, we want information to be relevant, we want it to be reliable, at least as best we can between the two. We want it to be comparable across companies, consistent over time, and then we want it to be understandable to somebody who understands at least the basic concepts of financial accounting. Don't have to be an expert, but at least you have to understand the basics. Okay. All right, now we're going to stop there, and we'll come back in a little while, whenever you click on the next button, and talk about the next element of our conceptual framework, which are the elements of the conceptual framework, all the different pieces that make up the accounting system. All right, I'll see you in a little while. Thanks.